Thank you, Mr. Turner. Ranking Member Mr. Schrader for an introduction. Mr. Jost.
Thank you, Mr. Chairman. It's my pleasure to introduce Professor Timothy Yost. Thank you for being here. Professor Yost teaches law at Washington Lee University School of Law. He's co-author of a casebook, Health Law, used widely throughout the United States to teach health law. Professor Yost is author of numerous articles on healthcare regulation and comparative health law and policy. And he's also a consumer representative to the National Association of Insurance Commissioners. Professor Yost earned his J.D. from the University of Chicago, cum laude. Very good, 1975. Come from Illinois myself. So welcome, Professor Yost.
Thank you very much, and thank you, Chairman Kaufman, for the opportunity to speak today, and Ranking Member Schrader and committee members. Of all the Affordable Care Act health insurance reforms already in effect, the most beneficial for American small businesses is the minimum medical loss ratio requirement. The cost of health insurance is one of the largest and fastest growing items in the budgets of small businesses. Fortunately, the MLR is bringing relief. First, relief will be coming through rebates. A study conducted by the NAIC last spring found that $450 million, $500 million in rebates, would have been paid to nearly 16% of American small businesses, and 23% of all employees had the rule been in effect in 2010. This year, when the rebates are actually paid, the amounts may be larger. But the purpose of the MLR is not to generate rebates, but rather to reduce premiums. The MLR produces a strong incentive for insurers to reduce their administrative costs and thus their premiums. But the real driver of insurance premiums is medical costs, and the most important benefit of the MLR is that as medical costs come down, premiums will be reduced accordingly. Medical cost inflation, in fact, has fallen precipitously in the last couple of years, and as medical inflation declines, the MLR will force insurers to pass the savings directly to consumers. Already last summer, the GAO report that Chair Kaufman mentioned said that the MLR was driving down premiums. Aetna in Connecticut recently dropped its premiums to small groups by 3.2%, while Mountain State Blue Cross in West Virginia announced yesterday that small businesses like Mr. Livengoods will be getting an average reduction in premiums for December of $2,500 for 4,200 small businesses, a 75% reduction in their premiums. Jim Hauser, a small businessman from Portland, Oregon, reports that his premiums went down 3% this year, and he was told it was because of the MLR. Brian England, small business in Columbia, Maryland, saw his premiums go down 6% because of the MLR. Some argue, however, that the MLR is destabilizing insurance markets. But as another recent GAO report found, most insurers were already at 80% before the rule went into effect. The HHS rule provides special treatment for new market entrants, for small plans, for high-deductible plans, for limited benefit plans, and for expatriate plans. And I would really encourage you to read the rule. It's very widely misunderstood. It allows insurers to exclude fraud recoveries and to claim credit for health quality improvement costs, including the full cost of ICD-10 conversions, up to 0.3% of premiums, which for most will be their full costs. States also can request MLR adjustments if they believe that it's going to destabilize their insurance markets, but 2/3 of the states did not do so because they did not believe they would have problems. Ms. Turner's testimony includes a long list of insurers leaving particular markets. I read through all of the citations of sources, and virtually none of those withdrawals are due to the MLR requirement. An example of this, Indiana, in its request for an adjustment, claimed that 7 insurers were leaving the market. 4 of those would not have had to pay rebates under the MLR rule because they were too smaller because they already met the MLR. 2 said they were leaving for business reasons. 1 had not even started selling policies in the state yet. None of them claimed that they were leaving the market because of the MLR. The most vociferous protests against the MLR requirements have come from agents and brokers, and I certainly understand the valuable services that they provide and their need for compensation. There's some evidence that insurers are cutting compensation, although the picture is complicated, as the NAIC found. Many are not. But it's not at all clear that those cuts are to be blamed on the MLR. For example, in Colorado, every single health insurance provider met the 80% requirement before the MLR rule went into effect. So although I don't doubt that Mr. West's commissions have been cut, I don't think it's the fault of the MLR. Cuts in agent and broker commissions are occurring because of business decisions of insurance companies, and they are blaming it on the MLR. If Congress took commissions out of the MLR tomorrow, insurers would probably not raise commissions. They would simply take the money for profit. Finally, Congress must consider what a legislative change would mean for the deficit. Employer-sponsored health benefits are heavily tax subsidized. As the MLR drives premiums down, tax subsidies will go down as well. If you add commissions to the administrative expense insurers already charge for small business, and that is what the Rogers bill would do, you're increasing the cost of small businesses for doing business. You're increasing their premiums, but you're also increasing the federal budget deficit by billions of dollars. Any attempt to eliminate the MLR rule or to change it to allow insurers to keep spending unchecked can only raise costs for small businesses and indeed for all insured Americans. I encourage you to support small businesses by keeping a strong MLR. And let me just say, although I'm a second over, that I was involved extensively in the NAIC's drafting of the MLR rule. I've followed it very closely, and I would be very happy to talk to you about what the MLR rule actually says and does. So thank you very much for your time.